Hello and welcome to the ASR Fintech. This episode we cover on compare senior debt to mezzanine fund. The web definition: senior debt is lower risk asset backed first in line for repayment with lower rates, while mezzanine debt is riskier, often unsecured, ranks below senior debt, carries higher interest, plus equity kickers like warrants, and sits between debt and equity in a capital stack, offering growth capital without immediate equity dilution but with greater cost and complexity. Here's the comparison. Senior debt are examples like bank loans. Priority is first to be repaid in liquidation. Security, secured by company assets, collateral. Risk cost, lower risk for lenders, hence lower fixed interest rates. Upside, limited to interest payments, no ownership. Control, strict covenants, and conservative. There's been senior debt. The other mezzanine debt are examples like hybrid debt, equity. Priority ranks below senior debt, above equity. Security, often unsecured, reliant on cash flow. Risk cost, higher risk for lenders, higher interest rates. Upside includes equity features, warrants, conversion, offering growth potential. Control, less restrictive, covenants, but cash flow strain possible. In summary of compare senior debt to mezzanine, the key differences and uses are: first, capital structure. Senior debt is the base, mezzanine sits above it. In the middle, to fill financing gaps for growth, mergers and acquisitions, or expansion. Number two, dilution. Mezzanine avoids immediate equity dilution, keeping control with owners, making it popular for family businesses. Number three, lender focus. Senior lenders focus on assets. Mezzanine lenders focus on future cash flow, EBITDA, and growth potential. Number four, complexity. Senior debt is straightforward. Complexity is complex and costly, but provides greater leverage. In a sense, senior debt provides conservative, secured financing, while mezzanine offers growth capital with equity-like upside, bridging the gap between traditional loans and pure equity. A finance news as published on Nasdaq.com on August 5, 2025 headline: SBIC and commercial finance stocks to watch amid industry headwinds, it read. The ZEX SBIC and commercial finance industry faces challenges as persistent high rates and tariff effects are expected to curb financing demand, slow investment income growth, and hamper refinancing activities. Asset quality remains at risk, as prolonged high rates may strain borrowers' ability to repay. However, regulatory changes, including relaxed leverage limits under the 2018 SBCAA, offer funding flexibility and support growth for the industry players. Therefore, companies like Ares Capital Corporation, Main Street Capital Corporation, and Hercules Capital Incorporation are worth keeping an eye on. About the industry, the ZEX, SBIC, and commercial finance industry comprises companies that provide finance to small and mid-sized privately held developing firms. These firms are typically underserved by traditional banks and other lenders. Additionally, firms suffering from financial distress are the primary target clients of these lenders. The industry players provide customized financing solutions ranging from senior debt instruments to equity capital. This financing is provided for a change of ownership transactions, buyouts, recapitalizations, and growth initiatives in partnership with business owners, management teams, and financial sponsors, among others. Some of the other products offered by the industry participants are mezzanine loans that typically pay high interest rates and can be converted into equity in the target firm. A related finance article is published on Yahoo Finance on March 17, 2023, headline: Mezzanine debt re-emerges as senior lenders turn more cautious, it read. Mezzanine financing is making a comeback. In recent years, private credit lenders, which have been gobbling up leveraged loan market share, have focused on other types of financing like unitranche deals, which combine senior and junior debt into a single loan. But as interest rates have risen and lending conditions have tightened, mezz financing, which is situated in a company's capital structure between senior debt and common equity, has found new life. Recent turmoil at regional banks may have further opened up investment opportunities for mezzanine lenders. A citation from research paper by the Academias, Professor Massimo Massa, INSEAD, Professor Rabi Mosawi, Villanova University, Dr. Andrei Simonov, Michigan State University, as published on the American Finance Association on January 2020 headline. The unintended consequences of investing for the long run, evidence from target date funds. The abstract read: we study how managers of funds created for the long run behave when shielded from liquidity constraints and their investors' short-term needs. We focus on target date funds, TDFs, for which the investment horizon of investors changes deterministically over time and is not due to specific idiosyncratic characteristics of the fund that can affect investor demand and spuriously link the investment horizon and unobservable fund characteristics. Our evidence suggests that asset managers exploit reduced investor attention to deliver lower performance. This results in a hypothetical cumulative return loss of 21% for the average investor holding the fund for 50 years. We find that this underperformance is driven by founder families using TDFs to smooth the flow shocks by overweighting affiliated open-end funds in the TDF portfolio. It also results from the higher fees arising from investing in the affiliated, expensive share classes. We used the Pension Protection Act of 2006 as an exogenous shock that made TDFs the default investment option within 401k retirement plans. This has been Dato Alexander Solomon reading you the ASR Fintech covering on Compare Senior Debt to Mezzanine Funds. For transcripts and related links, visit alexandersolomon.com. Once again, we credit mention for information sources of Google, Nasdaq.com, and the American Finance Association. Thanks for watching.